Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include takeaways from last Friday's CPI report, my interview with Rob Chrisman on, I was going to say takeaways, but we shouldn't say that twice, the MBA Annual Conference, the mood of the industry, and what to look forward to as conference season winds down. And we have a likely Fed rate cut this week. Let's look into the calculus behind that. You know, Optimal Blue is the only end-to-end capital markets platform built to power performance, precision, and profitability. Their cloud-native API, First Technology, connects the primary and secondary mortgage markets, helping lenders of all sizes operate more efficiently, manage risk more effectively, and maximize results. Optimal Blue. Modern technology, proven results. Since the beginning of the federal government shutdown, the only official economic data released was this past Friday, in the form of the Consumer Price Index for the month of September. Core CPI inflation rose 0.2%, which was in line with recent months, and it increased 3.1% on a year-over-year basis. CPI tends to run about a quarter percentage point above the Fed's preferred measure of inflation, the Personal Consumption Expenditures Index, so the September CPI report shows inflation is still trending above the Fed's target, and now sits at the highest level since President Trump took office. It's been more than half a year since tariffs were first imposed, and any meaningful inflation increase has not materialized. However, tariffs have begun to filter into consumer prices and could affect inflation readings over the next few months, making it challenging to determine whether rising inflation reflects underlying structural trends or temporary impacts from the tariffs. Regardless, this report clears the path for a rate cut this week and likely another one in December. No major changes to the language in the post-meeting policy statement are expected from the Fed, and Chair Powell's remarks should echo the sentiment from his public remarks on October 14th. That is, the Fed remains cognizant of the two-sided risks to the outlook given the current tension between their employment and inflation goals. Notably, changes to the Fed's balance sheet runoff program appear to be coming soon. Expectations are that the FOMC will announce the end of quantitative tightening at its meeting on December 9th and 10th, with balance sheet shrinkage ceasing, say that 4 times fast, after December 31st, though that announcement could conceivably come this week. For today's interview, I wanted to welcome back to the show my dad, Rob Chrisman, to talk about takeaways from MBA Annual, the mood of the industry, and what to look forward to as conference season winds down. I've picked up the mantle a little bit when it comes to traveling, so these days he's more likely to be with a grandchild than out and about on the road, but let's check in and see where he is.
Oh, breakfast time? Breakfast sounds good. I can make some breakfast. Uncle Robbie has a frozen pizza. Coast.
All right, hang on.
What are these?
I guess you could flip the question on me afterwards, but your takeaways from the conference. Actually, I'll go unsolicited first. I think you asked me about it, and I said the mood is definitely different than the last couple of years. I didn't get any real doom and gloom, and I think you responded. A lot of those people have kind of seen themselves out of the industry. But the mood was upbeat, and sure, maybe hope springs eternal in the mortgage industry. A lot of talk about tech and AI, obviously. But your big takeaways from the conference?
It was certainly good seeing everybody that we saw. I think that Chrisman LLC has a good reputation, so that's nice to see and hear. And people had some nice things about the products that you were putting out with your team in terms of the webcasts and podcasts and information. I think the overall mood was positive, and you're right. Many of the people who may have been marginal managers or marginal producers have either left the business or they didn't go to the conference. Because if you think about it, the conferences are a way to present a company in their best light, and companies spend a lot of money on people attending conferences, so you typically might not send somebody who isn't going to get a lot out of it if you're going to spend thousands of dollars. That said, I think that the people who weren't there should know that the industry is in decent shape right now. Volume is expected to pick up a little bit next year, both in units and in dollar volume. And the overall mood was good. So it was constructive, and companies are doing some pretty neat things out there in terms of not only the third party provider slash vendor companies, but also lenders are doing some strategic things, making some partnerships, adding technology where it's needed, and trying to move forward. And I think that the successful companies out there and the successful originators are willing to adapt, and they have been adapting to a changed environment and will continue to do so.
Let's talk about those forecasts briefly, because I disagree with the forecasts. I'm going to get myself in trouble here. MBA has a vested interest in saying volume is going to be better than it'll likely end up being. And I think for the last several years, they've estimated above where it actually ended up. How much faith do you put in forecasts? And I will add to that. Friday, we saw CPI come out just below where it was expected. Oh, inflation's humming along, but the government's been shut down. I'm starting to lose faith in forecasts. And don't call me a conspiracy theorist or something here, but it seems like you have to take into account the interests of some of these groups putting out numbers. Thoughts on that?
I don't know if that's exactly true. I've always wondered when in the stock market some company beats earnings estimates and how these estimates are derived. And I've talked to Mike Frantantoni and Joel Kahn, and before that, Jay Brinkman, about how the MBA derives its estimates. And to its credit, the MBA changes its forecasts every month. So every month, the MBA comes out with a new forecast, and the MBA adopts to changes that it's seeing and so forth. So I would say that on a rolling basis, the MBA's forecasts are better at reacting to current market conditions than other estimates. In terms of always overestimating volume, I think there are reasons why the MBA thinks that volume will pick up a little bit. It's not going to pick up a lot, the MBA thinks, but pick up a little bit. Interest rates are supposed to creep down a little bit, and it seems like every time interest rates move down a little bit, companies are seeing a lot of increased refi locks. Certainly, credit card debt continues to go up, and people need to refinance that credit card debt. So the MBA sees the opportunity that companies have to help borrowers and existing borrowers deal with that. And so that is I think the primary motivation for them seeing business pick up a little bit.
All right, that's fair enough. Let's get back to the conference. Any sessions you saw that you really liked? I know you and I were at Maria Shriver for a little bit, or tidbits you picked up in the hallways that you think are worth sharing with people?
I always tend to glean more information from just talking to people about business in general rather than watching a canned presentation on artificial intelligence or janitor. Oh my gosh. Generative, I don't know, generative AI. You're going to edit that, I hope. The, just the one-on-one discussions that I have with people that I meet for the first time or that I've known for 20 or 30 or even 40 years, I think are important. It's nice to see information presented in an orderly format. And I think that's done for the audience's benefit, but just hanging out in the hallways or sitting next to somebody waiting for the next session, I think is informative for me. And I genuinely like the people in the industry. And I think that is indicative of the industry in general. I like to think that most people like the people that they work with, even if they're competing with them. And so the information that's shared is often collaborative and helpful and can benefit our readers.
Well, let's look forward a little bit here. MBA Annual traditionally marks the wind down of conference season. I know you and I head to Texas later this week for the Texas MBA Housing Summit at the LBJ Library, which I'm looking forward to. Any travel beyond that? Could you talk about the flow of the conference seasons? You're as well versed in it as anybody out there.
I have the opportunity to visit Missouri in a couple of weeks before Thanksgiving to see folks in St. Louis and in Kansas City. Really, truly the heartland of America and also the industry in general. And I'm looking forward to seeing those folks. Past that, frankly, I don't have much travel until, maybe February. There's one or two events, I think, in January. But you're right. In December, I think a lot of the conferences we're done with, and people are focused on thinking about 2026 and the holidays and spending time with their families and so on. So travel really dies down. Also, from a selfish point of view, I've become less a fan of flying during potentially inclement weather than I have in the past, just because of the delays and TSA. And it just seems like the weather related delays pick up in the winter months and also in the summer months too. But I don't mind not flying in December or January. How about you? Are you traveling anywhere in December?
No, maybe I'll be in New York City for a little bit. My travel advice through all my travels, don't fly into Denver connecting or terminal destination in the springtime. You're guaranteed for some sort of rerouting or weather delay. Not guaranteed, but that's pretty bad. So as the industry winds down here, conference wise, how would you put what's the pulse you're getting about it? Just kind of what I said at the start, that we made it through the doldrums. We're on the upswing, or steady as she goes. People are a little overly optimistic with thinking rates are going to come down, when I think a lot of really intelligent forecasts have them staying in the 6% range next year and maybe into 2027. Thoughts on the cost to originate or efficiencies in the process, or just in general, what your sense is of the industry where we are right now?
I think after the boom years of 2020 and 2021, 2022 through 2024 have been spent trimming staff, making staff more efficient, ridding themselves of technology that they're not using, adding technology that is cost effective and useful. And so now I think companies are, I should say lenders are seeing the fruits of their labor pay off. It's kind of like, all right, we've trimmed the sails and let's see some wind. Let's move forward. And I think companies are ready for some increased volume. And in terms of cost per loan, this is going to sound maybe a little bit negative, but it looks like we've kind of settled around, $11, $12, $13,000 a loan for many lenders. And since all these companies are selling their product at roughly the same price and the servicing is valued at roughly the same levels, success is going to be seen by companies that can lower that cost to produce, but they may not be able to lower it much. It seems like we're kind of reached a plateau there. So we'll see what happens. But overall, companies are ready for some increased volume, and they've made it through 2025, looking ahead to 2026.
And finally, before I let you go, anything you're kind of keeping your eye on that's interesting out there?
I think it's important for companies to get their name out there and continue getting their name out there, whether you are a vendor or a lender looking to hire. And so it's good to have the industry see what you're doing. And it's interesting. I don't have my eye on any one particular thing, but it's just watching the overall trend in the industry and watch some of the neat things that vendors are coming out with.
Well put. Thank you for the time, as always.
You're very welcome anytime.
The recent decline in mortgage rates may have influenced September's 1.5% rise in existing home sales. Single-family home prices were up 2.3% from 1 year ago, and all regions except the Northeast saw price gains. Inventory continued to rise, although single-family inventory was 15.6% below September 2019 levels. With mortgage rates forecast to remain in the low sixes through 2026, it may be a while before the market reaches equilibrium. This week's month-end calendar is packed with central bank meetings, including the Fed, and Treasury supply. With the government shutdown showing no end in sight, economic data is expected to be limited to Fed surveys, house prices, consumer confidence, pending home sales, and Chicago PMI. While durable goods orders, the first look at Q3 GDP, and PCE are expected to be delayed. Besides the Fed on Wednesday afternoon, where a 25 basis points cut is nearly fully priced in, central bank decisions include the Bank of Canada on Wednesday morning and the Bank of Japan on Thursday. Supply will consist of $69 billion of 2-year and $70 billion of 5-year notes to be auctioned today and $44 billion of 7-year notes tomorrow, with $30 billion of new 2-year FRNs on Wednesday. Today's loan data point is Dallas Fed Texas manufacturing for October, due out later this morning. We began the week with agency MBS prices a few ticks worse than Friday's close, the 2-year yielding 3.50 and the 10-year yielding 4.03 after closing last week at 4.00%, down 1 basis point over the course of last week. Let's wrap up with a joke and some housekeeping. I took out a loan to pay for an exorcism. If I don't pay it back, I'm going to get repossessed. Thanks again to Optimal Blue for sponsoring this week's podcasts. Optimal Blue is the only end-to-end capital markets platform built to power performance, precision, and profitability, helping lenders of all sizes operate more efficiently, manage risk more effectively, and maximize results. To learn more, visit optimalblue.com.